Welcome to my channel. I'm Scott, and in this video we're going to talk about buybacks. Here's a list of slides we're going to cover: the basics of a buyback, the types of repurchases, why does a company do one, we'll look at some ratios, ROA and ROE, we'll discuss how dilution is affected, taxes, the effect on the balance sheet, and a summary at the end. The two main ways for companies to reward shareholders are to pay a dividend or to buy back stock. And a company doesn't have to pay a dividend or buy back stock. So how do you make money? Well, most people make money when they buy a stock and sell it at a higher price. They hope the stock doubles, triples, 10x's, 50x's. We all want to become millionaires and make tons of money on stocks. But if the company has extra funds, they could pay a dividend or use those funds to buy back stock. So say you're involved in a company that has 4 shareholders. You receive 1/4 of the profits. Let's say the company buys back one of the shares. Now there's 3 shareholders splitting the profits. Let's just say, for example, before the buyback, the company profited $120K. Since you own 25% of the company, you get $30K. But let's say after the buyback, the company still makes $120,000 profit. You split that 3 ways, so your profit goes up to $40,000. But if we were looking at a public company, there may be 1 billion slices. Then the company buys back 10 million shares. So it'll be 1 billion slices minus 10 million. But the idea is the same. You get a bigger piece of the pie. So it's pretty simple. A stock buyback is when a company buys its own shares, the same way we buy shares. And the effect of a buyback is to reduce the shares outstanding, which increases your percent of the company. There could be lots of different reasons a company buys back its own stock. Maybe they think the market has discounted the stock so much, they think it's a great value, and they want to invest in themselves or improve their ratios. And share buybacks are a great way to mitigate dilution. Sometimes companies offer lots of stock options to their employees, which dilutes the shareholders. So to try to fix this, the company buys back its own stock, which reduces the shares. And we have a whole slide on dilution later, so we'll talk about it in more detail. So the 2 types of buybacks are a tender offer or a company buying in an open market. A tender offer outlines the terms. So it says how many shares the company wants to buy back, the price range they'll pay, and companies usually offer a higher price than it's trading at, because why would anybody sell it at a lower price? Then there's a time frame for how long the tender offer is. It has to be at least 20 days according to the SEC. Let's say a company gives 60 days, and after 60 days, they still don't have enough shares to buy back. They could extend the time frame. A type of tender offer is a takeover bid. This is when another company tries to buy out a company's stock. Say the semiconductor company NVIDIA is looking to expand, and they want to acquire another company, and they see Marvell. It's trading at 930 million market cap at $5.36 a share. So they need 51% of the shares to acquire the company. They submit a tender offer for $8.04 per share, which is a 50% premium. It seems like a no-brainer, right? Why wouldn't you want to sell your shares for $8.04? And not all tender offers go through. So if NVIDIA wants to acquire 51% of Marvell, but they only get 40% of the shares, they may not complete the tender offer and they won't buy any. And a more common approach for buybacks is a company buys the shares at the current price in the open market, the same way we buy shares. And usually the announcement of a buyback causes the stock price to shoot up, because that is a positive sign when a company is looking to buy its own shares. And also mathematically, the stock price does go up because the number of shares goes down. So why does a company do a buyback? Well, it allows them to reinvest in themselves. The same reason you invest in a stock. You hope the stock goes up because it's undervalued. When a company buys its own stock, it hopes it goes up and it makes a profit. And the company always puts a positive spin on everything. The CEO will say the buyback is the best use of capital at this time. You may see in a press release, we don't see any better investment than in ourselves. That could be the case, but what's more likely is they're trying to inflate their financial ratios. You would hope a company does a buyback because they think their stock price is too depressed. And when you do a buyback, a byproduct is better financial ratios. I'll show you on the next slide. So we'll talk about ROA and ROE because these are positively affected from a buyback. So as you know, share buybacks reduce the number of shares outstanding. The company either cancels the shares or keeps them as treasury stock on their balance sheet. But either way, the shares outstanding goes down. And buybacks reduce equity and assets on the balance sheet. So the ratio ROA, return on assets, improves, it increases because ROA is net income over assets. When assets go down, ROA goes up because assets are on the bottom of the equation. Same thing for ROE. ROE is net income over equity. When equity goes down, ROE goes up. When investors see higher ROA and ROE, this is a positive sign to buy the stock. Let me give you an example. It'll make more sense with actual numbers. Say a company buys back 1 million shares at $15 per share. So that's $15 million. So before the buyback, they have $20 million in cash. After the buyback, they have $5 million because they have to use cash to buy back the shares. Since cash is an asset, assets also decline $15 million. They were $50 million. After the buyback, they have $35 million. Earnings do not change with buybacks. So your net income, your earnings are the same. And in this case, shares outstanding decreased 1 million from 10 million to 9 million. So ROA increases from 4% to 5.7%. ROA is how well a company uses assets to generate a profit. This indicates they're more profitable than before, but we know the reason their ROA went up was from the buyback, not from increasing net income. So before the buyback, ROA was 4%. It was 2 over 50. Net income, 2 million, over assets, 50 million. After the buyback, it went up to 5.7, 2 over 35. Net income or earnings is 2 million. It didn't change. And their assets decreased to 35 million. A higher ROA indicates a company's more efficient. They only needed 35 million of assets to generate 2 million of profit. Before, they needed a lot more assets. Earnings per share also increases. It went from 20 cents to 22 cents. Earnings per share is net income over shares outstanding. So it went from 2 over 10, 20 cents, to 2 over 9, 22 cents. The PE ratio is one of the most well-known ratios in investing. It's used by a lot of people as a benchmark for value. The PE also improves when a company does a buyback. When the PE goes down, the stock appears more attractive. So if the shares remain at $15 after the buyback, the PE ratio goes from 75 to 68. So the PE before the buyback was 75, $15 a share over 20 cents. PE is a share price over earnings per share. After the buyback, the PE went to 68, $15 over 22 cents. In the early years, when a company's starting out, they give lots of stock options because they don't have lots of cash to pay out. And they also want to compete with other companies to retain or attract new talent. Say you have a job that pays $75,000 a year and you want to make $100,000. And if the company says, we don't really have enough money to pay you $100,000, we'll pay you $75,000 and give you options. So you ask them to explain what you're receiving, what are the options. So say the stock is trading at $10 per share. Now if the stock hits $15 a share, you'll get $20,000 of stock at any point if it hits $15. And if it hits $20, you'll get $50,000 of stock. So you think this is a pretty good deal. You're making $25,000 less, but you may get $70,000 of options. Plus, if the company's doing better in a year or two, your salary will probably go up. But there's lots of different ways for a company to orchestrate options. Another way to give options is, say the company will give you 10,000 shares, but you only receive 2,500 on the first of each year, starting in 2023. So regardless of where the stock is trading, say it's trading at $2 a share, and on the first day of 2023, you get 2,500 shares. At $2, that's $5,000. Say the stock jumps up to $10 a share. Now you get $25,000. What if it goes up to $100 a share? You get $250,000. What if it goes up to $1,000 a share? Like Tesla, you get $2.5 million. But there is a chance the stock price goes down to like $1 or 50 cents and you get less money. Or even worse, the stock goes to zero, you get nothing at all. As you probably concluded, stock options work the opposite of buybacks. They increase the shares outstanding when the options are exercised. When we buy options in the open market, it doesn't affect the shares outstanding. But when a company offers options to its employees, then it usually increases the shares outstanding. And remember in the prior example on ROA and ROE, a change in the shares outstanding can affect the financial ratios. So if lots of options are exercising, the earnings per share and the PE ratio are going to get worse. So dilution weakens the appearance of a company. Let's talk a little about taxes. This is a really interesting topic because there's a brand new tax. On August 16th of this year, President Biden signed the Inflation Reduction Act of 2022. One of the provisions in the act is an excise tax of 1% on stock buybacks. The new rule goes into effect on the first day of 2023. So if any companies buy back stock this year, they don't have to pay that 1% tax. So you may see lots of stock buybacks in the fourth quarter. So after this year, if a company buys back more than $1 million of its stock, they have to pay a 1% tax. So as you can imagine, this will make stock buybacks less attractive than before. Because right now, corporations are not taxed on buybacks. So it totally boosted shareholder value. Now going forward, this 1% tax is going to reduce the company's overall cash balance. Dividends, however, are taxed at the ordinary rate, the higher tax rate. That's why certain investors prefer buybacks instead of dividends for the tax benefit. Buybacks are a great way to circumvent double taxation because when a corporation pays a dividend, they pay taxes on those profits, and then the person who receives a dividend pays taxes on that. So that's double taxation. Now let's talk about the fun stuff, how buybacks affect the balance sheet. So as you know, when a company buys back its common stock, those shares are taken off the market and carried on the balance sheet as treasury stock. Or the company reduces their retained earnings. Treasury stock is a contra equity account, so it acts the opposite of a traditional equity account. A contra account is used in a general ledger to reduce the value of a related account. When you net together the contra account and the related account, then you get the true value on the balance sheet. For example, accumulated depreciation is a contra asset account that's netted against a certain asset. So when a company buys back its own stock, cash goes down and treasury stock goes up. Since treasury stock is a contra equity account, that brings down the equity balance. But if the company doesn't carry any treasury stock on its balance sheet, then when they buy back stock, cash goes down and retained earnings goes down. It's so much easier when a company reports treasury stock because then you could see how much shares they bought back historically. When they just reduce retained earnings, you have to do a lot of digging. So say a company buys back its own stock at $100 a share, and say they reissue that stock at $150. The difference, the profit, is credited to additional paid-in capital. Now, if a company reissues treasury stock at a loss, say they bought the stock for $100 and then a couple of years later sold it for $75, the difference is debited from additional paid-in capital, assuming there's a credit to offset the loss. Now, if there's no treasury stock gains and additional paid-in capital, the losses upon reissuance of treasury stock are recorded as a reduction of retained earnings. I told you, this is real fun stuff. And when a company sells stock, cash goes up, owner's equity goes up, which is the opposite of a buyback. Every public company sells stock. In order to IPO, you have to sell stock, but many companies do additional stock offerings, especially in the early years. If you look on the balance sheet of Boeing or Starbucks, you'll see they have negative equity, and the main reason they have negative equity is they bought back so much stock. If a company wants to inflate their balance sheet and have lots of cash, they could just keep issuing stock. Of course, that causes lots of dilution, and if you're a shrewd investor, you'll notice this and not buy the stock for that purpose. But you want a nice balance. You don't want a company that issues too much stock or buys back too much stock. Usually a balance works out the best. And every company's balance is different. Some companies can afford to buy back lots of stock, like Facebook and Google do. Some companies can't afford it because they don't have additional cash flow. So let's summarize. Are buybacks good or bad? Yes and no. So it is good they reduce the shares outstanding, but it's bad it reduces the total assets. And it's good because it improves earnings per share, PE ratio, ROA, and ROA. But it's bad because it improved those ratios artificially. If the company's PE went down and improved, I would like to see they have lots more net income. That's why it improved, not because they lowered the shares outstanding. So you should ask yourself, is the company doing a buyback to prop up ratios, maybe to provide short-term relief to a depressed stock, or to mitigate excessive dilution? The truth is, we never really know why a company did a buyback. And sometimes I think the company's management might not know either. I hope you liked the video. Please leave a like, comment, subscribe. Talk to you soon.